All right, let's talk about the steps in the audit process. All right, now we just talked about things like, again, about the auditor. The auditor needs the qualification of the auditor, the competency, relevance, professional skepticism, questioning, doubt, everything. So if you look in your notes, you'll see this box that talks about, first of all, the qualification of the auditor and the quality of his or her work. What does that mean? They're properly trained. They're proficient as an auditor. Competency and capabilities. We've talked about understanding the industry and the business. It also means you're competent by having CPE, continuing professional education. You need, 80 hours or so every few years. Ethical requirements. That talks about, again, making sure that you are independent in fact, in appearance, no direct interest, no material indirect, which we will talk about in detail in the professional responsibility and ethics chapter coming up in that section. Also, skepticism and professional judgment, acting with due professional care. So that's really important in acting with skepticism. Now, in looking at doing the audit, there are a couple of what we call preconditions for an audit. And these are set up under what we call the clarity standards. And what the clarity standard says, there's two key considerations in making the decision if I should do an audit. First of all, the acceptability of the financial reporting framework being applied. Is the applicable financial reporting framework, remember, applicable financial reporting framework, is that financial reporting framework, general purpose or special purpose, is that framework the proper one that they're using? So is it, one of the things we'll have to do is evaluate, which we talked about earlier, whether or not it is the appropriate one. The second one is whether or not management is willing to agree to the fact that it understands and accepts certain responsibilities. Because management is responsible for what? They are responsible for the presentation and the preparation and fair presentation of the financial statements. Whose statements are these? Management's. So they are responsible for the preparation and fair presentation in accordance with the applicable financial reporting framework, whatever that may be, whether it's special purpose or the general purpose framework. Special purpose framework or general purpose framework. It says here also DIM, design, and we're going to hit this a lot, DIM, design, implementation, and the maintenance of internal control relevant to reliable financial reporting that is free from material misstatement, whether due to fraud or error. And I'm going to define fraud versus error versus non-compliance in a few minutes. Providing the auditor with access to all relevant information. We want to make sure that if we ask for something, the client gives it to us. If they don't, if we are not able to obtain sufficient, appropriate audit evidence, we consider that to be a scope limitation, which would affect the opinion. We would have to give, for example, a qualified except for, in my opinion, except for the fact that they didn't let us see this, or if it's very material, we might have to give a disclaimer saying, hey, I can't give an opinion. So that would affect, instead of having an unmodified clean opinion, we would have to modify the opinion. So those are a couple of things. Again, the preconditions for an audit. What are the preconditions? The acceptability of the applicable financial reporting framework and whether or not management is willing to accept that. The other thing we as the auditor we need to consider is, first of all, the auditability. Are these statements auditable? Is the company auditable? Can we get the information? Also, whose statements are these? Management's. Do they have integrity? Because remember, if management has integrity, they have ethics, they have morals, they have values, that's good. Chances are we can put more reliance on the numbers, on the controls, the numbers, and so on. If they have no integrity, that increases what we call audit risk, the risk that you give the wrong opinion on these materially misstated financial statements. That's called audit risk, which is scary risk. We'll define in a few minutes as well. If they have no integrity, you don't want to take the job. Maybe if you've taken it, withdraw. So these are things that we need to be concerned with in deciding whether or not to take the job. Now, first year audits, and this is AUC 510, this talks about, this is my first year doing an audit. Maybe it's the first year the client's being audited, or most likely they've been audited before by what we call a predecessor auditor. So what's happening is we're doing what we call a re-audit. And a re-audit means that we're coming out there and we're going to be auditing these numbers. And remember, last year's ending is this year's beginning. Okay, so last year's ending is this year's beginning, which shows up here. Beginning plus or minus changes equals ending. What's the ending number? The balance sheet as of December 31st, a picture of the company at the end of the year, versus the income statement is all the transactions that happened during the year. So what happens is, in looking at what we call a re-audit or first year audits, what we need to be concerned with is whether or not the opening balances are correct. Therefore, we are required to obtain sufficient, appropriate audit evidence regarding what we call the opening balances. Now, The auditor will read the entity's most recent financial statements and the predecessor's report. Remember, I'm the new auditor. I'm the successor. They are the old auditor. They preceded me, called the predecessor. Predecessor, successor. Predecessor, successor. So they preceded me. I've succeeded them. I'm the successor. Now, the auditor will read the entity's most recent financial statements and the predecessor, the old auditor's report, for information regarding opening balances, and that would be the account balances that existed at the beginning of the year and the disclosures. And a disclosure regarding things like contingencies and commitments. We will define contingencies, which says, you might recall from your intermediate accounting, is it probable and estimable? Is it a loss contingency? So it's remote, reasonably possible, it's probable and estimable. You might need to accrue, book it, and disclose it. So we need to find out about that. Also, consistency in the application of the applicable financial reporting framework. Has it been consistently applied? If I assume they used one method of accounting last year, we assume they used the same this year. If not, we better make sure it's clearly disclosed because it is implied that it is consistent. If it's inconsistent, either we need to fix it or we need to adjust the audit opinion. If the prior statements were audited, the auditor should request that management authorize the predecessor to what? So if they did an audit last year, then we need to request that management authorize the old auditor to do what? To give us certain information. Allow the successor to review the predecessor's documentation, so we should read the most recent statements. If a modified opinion was given, then we need to evaluate the effect in the current period statements, and we'll talk about a modified versus unmodified opinion. Respond fully to inquiries. So in other words, we need to make sure that the predecessor will respond fully to all of our inquiries. That is what, again, management needs to talk to the old auditor and say, hey, can you respond to my new successor auditor for these? So that, again, is first-year audits, or what we call a re-audit, and how it affects all of that. Now, once the client has authorized communication, the successor will generally make inquiries of the predecessor. So what kind of things are we going to ask them about? Now, when we talk to the old auditor, this information is considered confidential, not privilege. These are different terms. Confidential versus privilege. What is privilege? Privilege is information that you attorney-client privilege, right? You hire an attorney, you give them $1, valid consideration, which we'll learn in the regulation exam for business law. So we give them valid consideration. At this point, they are now biased for me. So if it is considered privilege, that information cannot be subpoenaed or summoned to a court of law. So let's say, for example, you kill your spouse in the shower. I forgot that person's name who got caught and someone put away, I think, for life. But you hire me as an attorney, and I'm here to defend you and say what a wonderful person you are and this and that, even though I saw the video of you killing the person, right? You showed me the knife. Look at the knife. Look at the fingerprints. Yeah, I did it, of course. But I'm out there saying, no, no, no. So I'm biased for the client. We as CPAs, accountants, we are unbiased, objective, neutral. That means the information we get is confidential, not privileged. Could it be subpoenaed at a court of law? Yes, it can. So with this confidential information, I'm going to ask the old auditor. Now, let's think about it logically. If I'm going to ask this older auditor and say, hey, there's some questions I have. Think of it this way. The questions I have are very broad, very general. In other words, I'm not going to ask about, hey, about internal control testing, did you do this or that? It doesn't matter because I have to do it again this year. I'm not going to ask about confirmations of receivables. Why not? I have to redo that again this year anyway. So what I'm going to ask them about is much more general, much more broad information. Think of it this way. Here's how I like to think. Let's say you met this great new guy or this great new gal and you want to date them. Wouldn't it be great if you could talk to their ex? Right? Wouldn't that be great? Because whenever you say, hey, how come you guys broke up? Oh, well, she did this and this. Oh, well, he did this and this. But you can't verify it. So let's say you could talk to their ex. That would save us so much time in dating. Now, what kind of things would you want to ask about? I'd want to ask about things that might make me want to get rid of them and see you later. So what might I ask? Reasons for the change. So I'm going to ask the old auditor, why is it that the client changed auditors? What is the reason that you're no longer the auditor? So I'm going to find that out. Same kind of thing. Hey, I'm going to ask that your ex-boyfriend, why are you guys, what was the reason for the change? Well, because she wasn't a nice person. I'm going to ask about the integrity of the client. I'm going to say, hey, did they have any integrity? Was there any issues? Well, yeah, they wanted to account for everything at the higher of cost or market. Doesn't sound like GAAP. versus did she have any integrity? Well, every time I left the room, she'd go through my wallet and steal my money. Maybe I don't want to date her. Disagreements during the engagement. Was there any kind of disagreements during the audit? Well, they wanted to do this, that, or the other. Same kind of thing. We fought all the time. Any communication with management or those charged with governance or other regulatory agencies, right? We want to find out about that. What about here? Well, I had a restraining order against her. Maybe I'll stay single. So what does that mean? Get rid of them. See you later. So that's my memory aid or mnemonic. And again, I've given you so many. I love these things. They help you to remember things for multiple choice, for task-based simulations. But most importantly, as I said earlier, I just want you to understand on it. I don't want you to memorize, but I want it to finally make sense for once in your life. So if you look in your notes, communication about what? Fraud, non-compliance with applicable laws and regulations, significant deficiencies, material weaknesses. These deal with internal control matters, which we'll talk about in a few other sections. That's what we're looking at. So again, RID, see you later. These issues are included in the application and other explanatory materials section. So when we talk about these issues, remember how we talked through the standards, and we said that the standards are set up where they have an introduction. So it talks about the introduction, the objectives, definitions, requirements, and application and other explanatory. That's where this RID-C fits in. So again, that's talking about what? The predecessor or the old auditor. Now, management and those charged with governance. What kind of things do we need to communicate to management and those charged with governance? Now, when we talk about it, who are those charged with governance? It says here, those charged with governance, which may include management. Members of management may serve as executive members of the board if owner-managed entities, management, and governance are the same. Those charged with governance may also include members of the entity's legal structure, such as company directors, parties external to the entity, such as governmental agencies, a collective group of people, such as a board of directors. Now, these people are in charge of what? They're responsible for overseeing the strategic direction of the entity and the obligations related to the accountability. So they're kind of looking at the strategic objective, the direction that we're heading in. That's the purpose of those charged with governance. So what we're leading into is what kind of stuff do we need to communicate to those charged with governance. Now, let's look at how the company's set up. We start here and we have management. Whose statements are these? Management. And management is responsible for the day-to-day operations. That would be CEO, CFO, controller, accounting clerk, bookkeeper, financial analyst. They work within the company. So when we look, whose statements are these? Managements. That's going to be management. Now, the management runs the company for the owners. Who owns the company? The stockholders. So I own stock in this company. I'm an owner of this company. So, for example, when I was single, I'd go out to the club and go, hey, how you doing? Hi, what's your name? And she goes, what do you do for a living? Oh, I own Microsoft. She goes, wow, right? I own one share of Microsoft for $30 a share, right? Or whatever the heck it's trading at. So I own one, but I am a shareholder. I'm a stockholder, so I own it. Now, one of the things as a stockholder, what do I get to do? I get to vote in whom? I get to vote in this group called the Board of Directors. Now, the Board of Directors, that's who I vote in. They are in charge of what we call the general operations. So these people are general operations, whereas management is day-to-day. So management runs day-to-day to day. The board oversees the general direction. So maybe if they're going to buy a huge fixed asset for $100 million, the Board of Directors may have to approve it. What else does the board do? The board hires and fires what? They're in charge of hiring and firing management. So the board, so let's say I'm a shareholder and I don't like the president. What can I do? Can I vote them out? No. What I have to do is I have to go to the board of directors meetings, or I get to vote by proxy. So when I get my statements in the mail, I get a little proxy solicitation, and I get to vote on certain things on the board. So if I don't like the management, I'll go to the board of directors meeting and I'll stand up and say, you know what, I don't like the CEO, I don't think he's doing a good job. And the board says, well, we like the management because it's my son-in-law. That could be a problem. So in this case, I cannot vote them out, but I vote in the board hires management, the management runs the company for me. So you can kind of see how this triangle is. Now, could you be this and this and this at the same time? Let's think about it. Roger CPA Review. I own 100% of the stock, I am the board, and I am president, CEO, and janitor. Okay, I'm everything. Am I publicly traded? Not yet. Okay, so I'm not a publicly held corporation, otherwise I couldn't do all those things. But We have members of the board that are not part of management. What are they called? The audit committee, or those in charge of governance. Now, what does the audit committee do? The audit committee, those are the people who hire the auditor, fire the auditor. Those are the people that we report our issues to. While we're doing our audit, we find problems, boom, we go to the audit committee, we communicate any of these issues to the audit committee. So with the audit committee, it says, in your notes, it says, audit committee serves as members of the board of directors. They're disinterested in the day-to-day operations, so they're not part of this. Hire and fire the auditor, receive their reports and communications, oversee the internal audit function. That's what the audit committee does. Now, there are certain things that we need to communicate to those charged with governance or the audit committee. And basically, another good memory aid or mnemonic, the things that we need to communicate is anything that we disapprove of. So anything that we disapprove of, that's what we need to communicate to the audit committee or those charged with governance. So if you look in your notes, what is this mnemonic or memory aid about what we disapprove of? It says disagreements with management about accounting policies or audit procedures, including why the auditor believes the appropriate applicable financial reporting framework being used is not the most appropriate. So if we have any disagreements, if we go out and we say, you know, you guys are using this applicable financial reporting framework, but I don't think it's the proper framework. You should be using a different one. That's a disagreement. Non-compliance with applicable laws and regulations, that would be your what? Your illegal acts. Now, in this case, and again, the terminology changed under the Clarity Project, the Clarity Standards. Instead of illegal acts, we call them non-compliance with applicable laws and regulations. Significant accounting policies adopted or changed. Adjustments proposed. With the adjustments, we have what we call an RJE and an AJE. That's called a reclassifying journal entry or adjusting journal entry. We may be reclassifying something from a balance sheet to an income statement, maybe something that they capitalized but should have expensed or vice versa. So that's a reclassification. Adjusting might mean the numbers are wrong. We have to adjust the numbers. That's adjustments. Prior discussions with management before acceptance. Problems arising during the audit. Responsibilities of the auditor under GAS to obtain reasonable assurance. Other information regarding responsibilities. Views of other accountants. In other words, why were they talking to other accountants? Were they what we call opinion shopping or what? And then finally, estimates in the records and the process used to obtain them. And we talk about the estimates. We talk about something called fair value. So those are the things that we need to communicate. So while we're doing our audit, if we come across with any of these things, we need to communicate these to management. Also, the auditor should not discuss detailed audit plan or specific audit procedures with the audit committee, since it might reduce the effectiveness. Well, that makes sense. When we're out there, we talk about general stuff, not too specific. I don't tell you timing of certain things necessarily. I don't tell you when I'm going to do a physical inventory observation. Or may not tell you which location. Let's say you have 10 locations. I'm not going to say I'll do this one and this one and this one. I might say have all of them ready and we'll show up, because I want to make sure that it's accurate. The other thing, I'm not going to tell you what materiality is, right? Because you'll say, okay, it's $1 million, so if you're going to commit fraud, just make sure the check's $998,000, right? Because no one's going to audit it. So there's certain things that I want to kind of surprise you with. I want to do test basis, so you don't exactly know what I'm looking at. So we don't want to kind of give away what the answer is, right? We want to make sure that they're surprised. Now, this is important as far as those charged with governance. We also have PCAOB requirements, and that's what AS-16. AS-16 talks about communication with those charged with governance. Now, this is for a public company. I'm back. Drop my pen. Now, with a public company, what do we need to communicate? You'll see that here. It says, the auditor should inquire whether the audit committee is aware of relevant matters, which may include possible violations of applicable laws and regulations. The auditor would also communicate an overview of the overall audit strategy, timing, as well as significant risks identified during the performance of risk assessment procedures performed. Basically, we're looking at things like the overall strategy. So with PCAOB AS-16, it talks about the requirements for communication. What do we need to communicate? And again, a lot of it disapproves still applies. This is non-public. You can also apply it here for AS-16. It says communication regarding the overall strategy includes specialized skill or knowledge needed to perform the risk assessment, the extent to which internal auditors will be used, information about other accounting firms expected to perform audit procedures, the basis for concluding that the auditor can serve as principal auditor when parts are performed by other. We call that a group audit versus a component audit, which we'll define later. The auditor will also communicate the results of the audit. So we'll talk about significant accounting policies and practices, critical accounting practices, critical estimates, significant transactions. We need to evaluate the financial statement presentation and disclosures, new accounting pronouncements, alternate accounting treatments. Other matters, we're going to talk about the auditor's responsibility, difficult or contentious matters for which we looked at outside consultation, maybe attorneys, going concern issues. In other words, we don't know if they're going to be around next year. That would affect the audit report. That's called a going concern doubt. A going concern is a business. It doesn't mean you're concerned about them going, right? A going concern is business. A going concern doubt means, hey, are they going to be around next year? I don't know. Maybe they're not doing so well. Maybe it's Blockbuster Video trying to, and they're switching over to Netflix as a competitor. So these are things. Uncorrected and corrected mistakes, material written communications, modifications of the audit report, disagreements with management, right? Difficulties in performance. So again, that kind of relates to disapprove as well. It says, unlike communications under GAS, the auditor is required to submit the communication to governance prior to the issuance of the audit report. So unlike communication, the auditor is required to submit the communication. So what we need to do is we need to communicate this to management. We are required. And that's where it talks about under PCOB, you're required to, versus under AICPA, non-GAAP. These are things you should communicate, not necessarily required, but you should. The big difference is should versus required.